Okay, everyone, welcome back to another Coffee Microcaps Fund Manager interview. And I'm delighted to say we have Peter Johns from the Westferry Fund coming back to us once again. Peter, how are you?
I'm well, thanks, Mark. Thanks for having me.
And Peter has a bit of notoriety here at Coffee Microcaps. His first interview is our most watched video ever on the YouTube channel. It's got over 1,000 views now, and I think I saw somewhere only 8% of videos make it over 1,000 views. So he's batting in the big leagues now with the YouTube stars.
We'll see if I can live up to it.
Yeah, let's see if you can crack another 1,000 views here. Peter, but for anybody who might have missed your stellar performance the first time around, or don't know about the Westferry Fund, maybe just give us a quick pod history of the fund, kind of strategy, areas of the market you like to play in.
Sure, it's an unusual fund in that it's grown out of a personal investment fund that was for myself and then friends and family, and started with a few $100,000, and over time has grown to what it is now, which is just over $20 million in assets. It's now an AFSL licensed wholesale fund, but it's unusual in the type of assets we invest in. The main part is conventional enough. We focus on small and microcap companies, mostly Australian, some overseas. And we focus with our listed side of things on companies that are generally profitable or very near profitable. We tend to avoid mining exploration or more speculative companies. So we're looking for companies that are making a profit, but where the market has for some reason fallen out of love with them or is getting something wrong. But the fund also has developed a bit of a secret weapon, I think, in that we invest in a number of other small and up and coming investment funds, and that provides us with a real network of very smart people who are engaged with management teams in Australian and overseas markets, and by being a sometimes significant investor in those other funds, I certainly feel a lot more comfortable about shaking those managers down for information. So that allows me as a sole manager of a reasonable amount of money to still be across a lot of information. And then we also invest in some unlisted positions, not really pre-IPO stuff. It's unlisted positions where we just really like a company and want to hold it longer term. And then we also have some fixed interest exposure. Again, not claiming ourselves to be experts in that area, but sometimes fixed interest opportunities come up in the areas where we are experts to some degree.
Yeah, so quite a broad mix, but yeah, a good what shall I say, a good spread of assets for people who are looking for something maybe a bit more than your traditional pure 100% equity fund.
Yeah, that's right. And I try to keep investors up to date on in what we're in, so they can feel part of the ride, even though it is a spread of assets.
Okay. Well, we've got two stocks now, neither of which I think have ever presented at Coffee Microcaps, either the in-person conferences or online. So they definitely might be new to some people. And the first one we're going to talk about is Connexion. So maybe for people who and I'll also say both these stocks kind of keep a pretty low profile on the investor relations media side. So another reason maybe people haven't come across them. So I think maybe if we can start with Connexion and just give us a background on what Connexion does and how these guys make their money.
Sure. Connexion's a software development company. It's although listed in Australia, it has very much an American orientation. I suppose stepping back a bit, it's been on the ASX for a long time and for many years sort of chugged along, not doing a lot. Throughout that time, it's had one product and unusually one customer. So the product is a software that manages the vehicle management for dealerships. In particular, it deals with the courtesy transportation side of things. So think when you take your car into service, the dealership will usually provide you some way of getting home, whether it be a loan vehicle from the dealership, an Uber, or a rental car, and Connexion provides software that tracks that process, enables the staff to ensure that the service being offered to customers is of a very high quality, that the cars are tracked, telematics are tracked, and detail is constantly coming back to the dealership. More importantly, it enables the OEM, in this case, that's General Motors, to ensure there's a uniform and high quality of service being offered across its thousands of dealerships in the United States. And so that is the one customer, General Motors. General Motors pays Connexion to provide its software to each of these thousands of dealerships throughout the United States. And for many years, that was done at a very base level. It allowed the company to chug along at a barely profitable sort of level. It's always been mildly interesting, but never shown a great deal of impetus or ability to grow. But that changed in February this year when General Motors agreed to basically subscribe for a much higher level of service from Connexion. So previously, there'd been a lot of add-ons that were made available to some of the bigger dealerships. General Motors was sufficiently impressed with the quality of those that they agreed to pay a fair bit extra, to the tune of around $250,000 a month extra, to enable every one of their dealerships in the US to get this high level of service. So that's how this company makes its money, and it's really taken a step change this year because of that extra money that's coming in.
And if we is what I guess was that the change that kind of attracted you into it, or what's the kind of main investment thesis going forward? Is it kind of they've really kind of earned their stripes with General Motors now, and there's a potential to start, working with, whoever, Ford, I'm just thinking US dealers here now, Ford, Chrysler, Ram, or, bringing it, into Australia on the, or, maybe with like Toyota Australia, for example.
Just on the last point, they often get asked about that, and they're just, Australia's not a big enough market for them to worry about, is their point on that area, which was probably fair enough. Yet profitable, which attracted me. A couple of years ago, a guy called Aaron Nania became the CEO. Aaron had previously been in an investment fund that had been invested in this company and transitioned across. And I knew him as someone who was a very switched on, sensible allocator of capital. It wasn't entirely clear whether he was someone who could run a business on an operational level, but the subsequent contracts he signed suggested he has been able to do that. So I was attracted to that. And yes, the step up in earnings meant that it went from a company that was sort of barely surviving, eking out a modest profit, to one that suddenly had, around $2.5 to $3 million extra a year in money that it didn't really need to maintain the existing product. And so if purely on valuation grounds, which I'll come to shortly, it was then very attractive. It's a company that has now around $6 million in net cash and investments and no debt. It's got a market cap of 21 million. And then for this extra 15 million enterprise value, you're getting a company that now can, if it didn't want to grow at all, if it just wanted to maintain its existing product and sell it to General Motors, it could be pumping out 6 to 8 million Australian dollars net profit before tax. So you can see that it's some extreme value there, albeit one with extreme risk because they've only got the one customer. What they are doing, and we've made very clear, is they're going to take that extra money and reinvest it into the development of other products, which has its own risks. But they've always had a generic version of their software that can be used for other dealerships. They've just never had the money to spend on sales, nor to properly develop that. So I see it as a company that basically gives you a free option on a much bigger play on the American mobility market, as they like to frame it, but certainly in the short space, yes, all those companies you mentioned, Ford, Chrysler, they've already got approval from Ford to have their software is allowed to be sold to Ford dealerships. It just hasn't actually been sold to any yet. But you now have a stable level of income that keeps it profitable and a free punt basically on their ability to sell software across a much bigger market.
Yeah. And you touched on some of the risks there. I mean, are some, I guess, you know, one of the risks, as you say, you know, they develop software that goes nowhere, you know, they can't really expand, and I mean, the biggest risk of all is they lose GM. In terms of that GM contract, is that at a enterprise level, which I'm guessing then, you know, lasts for like a couple of years, and I'm not sure when the last renewal was, or is it, you know, down a level where regions or states or individual dealerships even, you know, are kind of committing to Connexion's service?
It's very much at an enterprise level, one for the United States, and that is renewed every 5 years. They're on their third, perhaps fourth renewal now. It's about 2 years perhaps into the current 5-year tenure. So, and you know, the recent upgrade suggests that things are reasonably good there. There is individual deals done with dealerships where they might want to get some customization or upgrade to specific to their particular dealership. So that adds some extra money, but there's nothing that creates a customer risk there. So yes, the GM thing is crucial. Look, if GM, you know, decide to go on a mad cost cutting process and cancel it, you know, it can be cancelled, I think, on a year's notice or something like that, then that would be a major problem. So you're taking that risk. And then, yes, can they take that product and expand it in two ways? One, take the sort of existing product for the courtesy transportation process across two different brands. And secondly, can they get some traction with the 3 or 4 other products that they have already in development. You know, they've made some great steps in recent months in that regard. They've got a whole team, 3 or 4 developers that have been working for car sales who have come across to start working on those. I understand one of those people is in fact going to be made the Chief Technology Officer. And so they're getting good people in place, but yes, the proof is ultimately in the pudding, I suppose.
Yeah. So I mean, if we, I guess if we, you know, crystal ball a bit and we look out, you know, 12 or for 18 months down the line, you know, what are you kind of expecting to see from Connexion? Obviously, it sounds like, you know, we're in the middle of the contract for GM, so that should kind of just tick over pretty as normal. Is it, you know, getting a few, you know, dealerships on board, whether it's, you know, Ford or Chrysler or, you know, whoever, even if it's, you know, just a guy who owns 5 dealerships in North Carolina, but at least it's, you know, it's something, it's outside the GM thing. Is it, or is it more, you know, what these developers can push out in terms of new products and where the opportunities might come from that?
It could come from both, and it's hard to say which will come first. The new products, for instance, would be most easily upsold to GM. Things like, for instance, a software add-on that deals with tolls and, you know, seamlessly ensures that that's all fed through and paid properly, is something that might be easily upsold to GM. But yes, it would be better and more exciting, perhaps, for investors to have the base product sold to different brands. So there are things that I hope to see. Certainly the 18 months is a reasonable time frame. The thing I like about Aaron as a CEO is he's very focused on investor returns. They've got spare money and they're using that for a reasonably aggressive buyback at present, which I like to see. Secondly, he set out two quite good metrics as to how he will track his performance. So the all of the R&D work and extra money that's going into sales is all going to be expensed. None of it will be capitalized, and so that will have an effect on the P&L. But he set out in his last announcement, which you can have a look at, metrics by which there's going to be quite a good way of measuring the return on that extra capital. So if that extra money, we could just be sitting collecting cash, so it needs to be well spent. And he's quite importantly set out metrics that will measure the return on that extra incremental capital that's being deployed. And if it's not paying off, then there'll be some shareholder pressure, and there's some quite activists and good shareholders involved in the company to make sure that that's stopped if it's being spent in a way that's not productive.
It definitely sounds like an interesting one, and we're going to switch from I guess a software technology company to a company who's also kind of on the high-end technology side, but in the mining space. XRF Scientific, another business has been listed for a long time. I think I want to say like the mid-2000s. I kind of vaguely remember them coming to market, and they actually did pretty well from memory, once they listed. But it's kind of a business I followed for a long time, and it also maybe a bit like Connexion has, you kind of say after nearly 20 years on the market, how is it kind of still a microcap kind of thing? But it does keep a low profile for sure. I know the long-standing CEO there, he's not one for media engagements or IR engagements outside of the things they run themselves in the AGM. So maybe just give people an overview of XRF Scientific and what they do.
Sure, and XRF's an example, I think, of you're right to be cynical about companies that have been listed for this time, but sometimes because of the right people or the right conditions, they can suddenly gain traction. And XRF is one that, if we went back 5 years ago, probably wasn't much bigger than CXZ, but is now a company with a market cap of around $130, $140 million instead of 20. And that's following 4 or 5 years of really quite impressive year-on-year growth. But in terms of what they do, it's a fairly specific sort of area they focus on, and it's XRF's, the code and the name of the company stands for X-ray fluorescence, and it's a method of examining materials, and it's essentially involves the crushing up of materials, and usually that is, in the case of their business, mining, so iron ore, coal, but it can be anything else that is used in construction materials, for instance, so cement, glass, and more recently they're moving into an area with a new product that's only just been released that allows examination of things like food products or plastics, and all of what they're examining is the process that they focus on, and allows an examination of these materials and to work out the chemical makeup or the molecular makeup of these materials. So you can think that is quite useful in the case of mining, for instance, because the customer wants to know that they're in a certain sample or in a certain part of a shipment, they're getting a certain level of purity in a material. It's important in things like bitumen or concrete or glass, because you want to know exactly what those things are made up of, so that you know that they have the proper structure and strength that they're required to. And in things like food and plastics, the more recent developments allow them to examine things like moisture content and the like. So there's only sort of 3-4 real competitors who are doing these things. When I say these things, they're developing the machines, the detecting machines that allow the process, but their business model, similar to a printer, I suppose, they sell the machines, but then they also sell the consumable parts for those. And there's a couple of parts there. One, the machines really require finely engineered platinum ware to hold the samples, and so XRF make those. and as a sideline, because they have the ability to make finely tuned platinum objects, they can also use that for some areas outside, like aerospace or in other sort of industries who demand that particular type of product. And then also, when the sample is being examined, it usually has to be crushed to a very fine point and then mixed with other chemicals. And so XRF sells the other chemicals to allow the sample process. And most recently, they've bought a firm that develops a range of crushers that allows the sample originally to be crushed to the precise level, and in some cases separated at different sizes that allows different testing to take place. So they sell all these products to sometimes very big companies who have the in-house capabilities, such as BHP, Rio, or very big industrial companies in Europe. One of their biggest customers, though, in Australia is ALS, which is the listed testing company, $6 billion company, who buys these things off XRF, and then obviously has their in-house team of laboratory workers and laboratories themselves to put them to use. And
in terms of the investment case, what attracted you to it? Is it kind of this consistent run rate that they've been on over the last few years, or was it the kind of move into the new products, into the food and plastics? What was kind of the thing that sparked your interest in them?
Initially, it was sort of an examination of the accounts where you could see that they'd started a new division in Europe, which was loss-making for a number of years, and that was really affecting the overall business. But you can see the Australian business was quite profitable, and it was clear that the European business was going to get there, and so that's where we became involved. The European business did get there. The profit sort of got quite a big boost when that division went from loss to profit. And then, as we got to know the company better, the real attraction has been the CEO, Vance. He has a very understated nature. He's not interested in blasting the story out there for the sake of it. He has a level of investor communication that I think a lot of companies should aspire to. You may prefer them to be more outgoing, but he provides hard and fast quarterly updates with precise profit figures, no mucking around, a scarcity of normalizations or any of that kind of stuff. So, and it also became clear that he's, I think, a very good allocator of capital, which again is not the case across different areas. They've bought back stock where appropriate. He's had a lot of pressure on him for a number of years to use the cash that XRF has for acquisitions to try and grow a bit faster. He sort of resisted that for a long time until finally in September 2021, they did make a purchase. They bought 50% of a company called Orbis, which makes these specialized crushing machines. And he could see that was a company that had a good reputation, but just didn't have the working capital to expand or the sales network to properly sell these things. And so he's plugged that into XRF, used XRF's capital and sales ability, and the figures speak for themselves. So that company, 50% of it was purchased for $800,000 in 2021. Last year in FY23, the 50% that XRF owns returned a $700,000 in profit before tax in less than 2 years. It's basically paid for itself, and the indications are it will grow stronger next year. So I like the fact that he's as a CEO, very strict with the uses of capital, has a strong history now between the growth of the European venture, which was a sort of a greenfield venture, the acquisition, and most recently the release of some new products that make us feel that this is a real sustainable growth story, not without some cyclical risks, which we'll come to, but while he's there, is a sustainable story with limited competition. It's almost like an oligopoly of sorts in this area. It's not a big enough industry for people to be willing to rush into, even though the profits are reasonably good. And it's also, Vance himself owns a good chunk of it. He's been buying shares using his own money on market, and that's something we like to see. So all of those things have kept us enthused with this stock, even though the price has gone up and the multiple has gone up.
And yeah, you mentioned cyclical risk there might be a good way to segue into some of the risks there. I mean, is that kind of the biggest one? As I associate kind of XRF, being very tied to the mining industry in terms of its customer base. It's been a while since I looked at it, so that mightn't be as true today as it was a few years ago. But I mean, is that kind of the biggest risk? We kind of in this. Oh, I'm loath to say a commodity downturn, because we're not really scraping the barrel with prices, but they're definitely off the highs we saw in COVID. So
Yeah,
is that the kind of main risk for this business, that they're kind of dependent on a decent commodity price cycle to kind of really keep volumes at a nice level through the business?
yeah, it's fair. The non-mining part of the business has expanded quite well over the last 5 years, and there's been a real focus on that in terms of industrial products, especially to the European business. But as much as they try to diversify in that way, the mining side of the business keeps growing faster than it. And I think it's not so much, they're not so much concerned about the boom and bust cycle in mining that comes from different prices, for instance. They benefit from volume. So even though the coal or iron ore price might fluctuate wildly, the level of shipments of those commodities tend to stay reasonably consistent. They do sort of benefit from more drilling and exploration as well, and that can obviously be cyclical. So yeah, that is a concern, that could affect their sales, because it does remain a large part of the business. But as I say, it tends to be less around the more volatile parts of that industry that would affect it. Rather, it's the real big picture stuff. Is the iron ore volume gonna drop like a stone? Look, if you're a China bear, maybe you think that's the case. But there should be a reasonable time for XRF to adjust.
As you said, they've got the European business and some other products to try and diversify it away, and hopefully the growth in one can maybe offset even a lower growth rate in the other. And then I guess the same thing, 12-18 months for XRF. Is it just kind of looking more the same? It sounds like to just keep kind of on strategy, on brand, with grow the European business, get the new products in there, maybe buy out the other 50% of the other business. It seems like a natural progression if they've kind of been in there for 2 years. Is that kind of things you're looking for in XRF in the next 18 months?
Yeah, all those things. I'd be interested in the other 50% for sure. I'm sure Vance would too. But there's a new product which has just been released, so a new piece of capital equipment that uses a slightly different methodology and can do different things, detect various extra aspects of a makeup of a product, in particular moisture content. That is only just been released, and so it'll be interesting over the next 6 months to see how well sales of that progress. And obviously, as each one of those is sold, they generally come packaged with some of the platinum wear, and then the consumables start to be used in that as well. So I'd hope to see some growth from that. Look, a major brokerage just put out, so they released their first quarter results last week, which to my eye looked completely fine. They made 2.8 million profit before tax in the first quarter. And that's despite the fact that they've got a massive backlog of orders for their capital equipment. So they're taking orders through till April, May next year, which is a good problem to have. But it has meant that some of the other platinum wear that's been bundled with it hasn't been processed as a sale yet. So a major brokerage suggested that there was some disappointment in terms of comparing the first quarter to the fourth quarter last year. Now, this is the type of inefficiency in the small cap market that you can get because, closely following this company for a number of years, it's very clear that the first quarter of each financial year is traditionally the lowest when it comes to profit before tax. That's been the case quite noticeably in each of the last 3 financial years, for instance. So for this major brokerage to preface a report primarily around a quarter-on-quarter flatness, is a misconception of how this business operates. And in fact, to our view, the fact that this quarter was not too much different to the fourth quarter, traditionally a strong quarter last year, is actually a good sign. The language for the next quarter, the second quarter is traditionally the strongest, was also quite bullish for the CEO, in my view. So yes, we're looking to see some growth, and it's not going to be as strong as it has been the last 3 or 4 years, which has been extremely fast growth. But it's a company that deserves a high multiple because of its quality of earnings, its strong balance sheet. They own property, which is on the balance sheet at cost. They have net cash, large amounts of inventory, which is really good inventory. It's hard platinum that can be melted down and sold. So it deserves a high multiple. And yes, we're hoping to see a less strong but still steady growth over the coming years, with perhaps a bonus from another acquisition if that can be made, or through the new products being more successful than perhaps hoped.
Yeah, maybe just one final question on the, you say it's kind of an oligopoly, and ALS is kind of one of their major customers. I mean, ALS has bought up dozens of these like little labs kind of over its history. If they were ever to get together with one of their competitors, do you think wherever that competitor might be based, that they could get away with regulatory competition concerns, given they're kind of selling into major mining businesses that operate globally? Like, is that a possibility at some stage down the line that they could acquire somebody, or they could get acquired by somebody else who is in that market and really understands that kind of value of the business?
Yeah, it could. I'm just trying to remember now. There's a company on the New Zealand Stock Exchange that has some similarities to it. The other competitors are sort of more small parts and much bigger industry, much bigger companies. I think that the issue is that if you look at the multiple the New Zealand companies on it, it's also very high. It's not obvious that they'd get a great deal from buying one of their competitors, but I think for the right price, it would certainly be an option. And I don't think there'd be a major concern from a regulatory point of view. There's so that's certainly something I know that the company is on the lookout for. I suspect the answer is that there's the right price has never come along, and there's no particular reason for the other competitors to want to sell. Whereas there are some complementary sort of smaller bolt-on opportunities such as Orbis that are more likely to come along at much cheaper prices.
Yeah, there's more different players in the value chain that, as you say, can once slot into the XRF distribution and marketing and networking. It actually kind of makes more sense.
Exactly.
Peter, thanks very much for coming back and joining us once again. If anybody wants to find out more about Westferry or get in contact with you, what's the best place to look you up?
Yeah, the website's the best place to start, westferry.com.au, and that's got my details. Very welcome to contact me. I generally get back fairly on Twitter. Westferry has its own Twitter page, Group Westferry, or at Group Westferry, and from there you'll probably find my alter ego, Microcap Jesus on Twitter. So any of those ways, and I'd love to have a chat to anyone that wants to talk about these stocks further.
Yeah, and yeah, you can. The Westferry one is a good corporate account, and Microcap Jesus is the next alter ego account. I can recommend following both. There's the PC version and the non-PC version, which is good. It's good to have a bit of fun. You need you need a laugh in this market, that's for sure.
Yes.
Peter, thank you very much for joining us. And I also just want to mention, yeah, Peter's based up in Brisbane, so he's not in the financial capitals of Melbourne and Sydney, which is also good. It's good to have a few managers scattered around the country. So yeah, if anybody is Brisbane based, you might run into Peter up and down Eagle Street there, maybe. And Peter, let's leave it there, and we will hopefully catch up again maybe some stage in 2024.
Great. Thanks, Mark.